Okay, so welcome everyone. This is Managerial Accounting. We're going to spend this next semester discussing various concepts and methods to provide information to internal users of a company. So we know that financial accounting provided much more generalized information to external users, banks, investors, tax authorities, communities. Whereas this class is going to focus on detailed information for internal users within the company to make decisions. All kinds of different information, closing plants, keeping them open, what types of products to focus on or to increase in sales. Know that in this first chapter, we're really going to be focusing on a lot of definitions, but we need to establish some of these understanding of these definitions in order to move forward. So we have to classify various costs. Now we know you all had in financial accounting a small understanding of inventory. And usually we focused a lot on merchandising companies where they purchase their inventory completed. This is a whole different animal in managerial accounting, because when you've got a manufacturing company, they start with raw materials and have various beginning inventory, work in process, ending inventory to finished goods. So a lot more involved in that category, the asset called inventory. Ultimately, the purpose of doing this, of providing information to those internal users, is so they in turn can make decisions that are beneficial for the company. So we start with classifications of cost. There are direct costs related to producing products, and there are indirect costs in relation to producing goods. The direct costs are traced to a specific unit of product. Direct cost, direct materials, and direct labor. So direct materials are specific items that go into producing that product. For an automobile, the windshield, the radio, the leather, the steering wheel, the carpet, the computers, directly associated with a product. Direct labor would be those individuals specifically working on that assembly line. Okay. Indirect cost, which there's a lot of them, are costs that aren't easily traced to a unit of product. We lump all of these indirect costs into an account called manufacturing overhead. These indirect costs are needed to support the manufacturing process, but they're not specifically linked to any cost object. Rent, utilities, general office expenses, are a few of the indirect costs that are associated with manufacturing companies. Oh my goodness. So manufacturing costs, we break down into three specific categories: direct materials, direct labor, and this huge bucket that is called manufacturing overhead. The direct materials are those items that are linked with a product and can be traced specifically to the product. For an automobile, you've got a radio, you have speakers. Those are specifically linked with a specific product. That would be a direct material. Direct labor are those costs, those labor costs that are traced to individual units of product. Assembly line. Wages paid to those assembly line employees would be considered direct labor. Then we have this manufacturing overhead. That is everything else except direct materials and direct labor. They're not specifically traced to products, finished goods. This would be any indirect materials and indirect labor. Excuse me one second. So, indirect materials may be the oil to grease the machines. Indirect labor may be the supervisor in the factory warehouse. Okay. So, examples of manufacturing overhead. The depreciation on the equipment. The utility costs, electric, the gas for a warehouse. The property taxes associated with the factory building. Insurance premiums. These are all costs that are necessary, but they're indirectly associated with the products. Now we have some other costs that we call prime costs and conversion costs. So we're learning a lot of new information this week, and it will all flow together. Direct materials and direct labor also are known as prime costs. Direct labor and manufacturing overhead are also known as conversion costs. What we've been focusing on are specific costs related to manufacturing products. There are non-manufacturing costs still necessary, but they aren't specifically linked with producing the products. Selling costs are those costs that basically get the order etched in stone and deliver the product. Some selling costs can be direct, some are indirect, but they are non-manufacturing costs. So know with your selling costs, they aren't included in inventory. but they are necessary to get done. Then we've got the administrative costs. This is related to the management. Administrative costs can be either, again, direct or indirect costs. The administrative costs are essential. They just are not included in the manufacturing of a company. So again, necessary costs, they're going to be what we call period costs. They're going to be on the balance or on the income statement. They're not going to be linked with inventory. So as we see here, the PC Works assembles custom computers from components supplied by various manufacturers. The company is very small, and its assembly shop and retail sales store are housed in a single facility in a Redmond, Washington industrial park. Listed on the next slide are some of the costs that the company incurs. So for each of these costs, we have to talk about if they would be direct materials, direct labor, manufacturing overhead, selling, or admin. Okay. So the cost of a hard drive installed in a computer. What do you guys think? What does that sound like? Wouldn't that be a direct material cost? It's specifically identifiable for a specific item inventory. Okay. So that direct materials. Next, the cost of advertising in the Puget Sound computer user newspaper. Wouldn't that be an advertising cost? That is a non-manufacturing cost. So it would be a period cost, meaning it would be recorded when this actually occurs. It's a selling cost, part of the income statement. It does not get carried with the products until it sells. Next, the wages of employees who assemble computers from components. That would be direct labor. They are directly associated with their hands on that computer, working specifically to complete and manufacture that good, that product. Direct labor. Sales commissions paid to the company's salespeople. This is a non-manufacturing cost under selling. The salary of the assembly shop's supervisor, manufacturing overhead. It is linked with the production or the manufacturing of the goods, but it is not directly linked. Therefore, it falls into the manufacturing cost of manufacturing overhead. The assembly shop supervisor. The next, the salary of the company's accountant would be an administrative cost. That again would be a non-manufacturing cost. Depreciation on equipment used to test assembled computers before release to customers. Again, it's part of the manufacturing or the production of the product, but it is not directly linked. Therefore, it is manufacturing overhead. Rent on the facility in the industrial park. This is going to be a lump. Little tricky here. This is going to probably have some admin piece to it, probably some selling, and also probably some manufacturing overhead, because I'm sure part of the production occurs in this facility. So the rent's going to be prorated based on percentage of square footage use for the various departments. Okay. So as you see here, what we're beginning to do is take cost and allocate them to the various cost classifications. Okay. So now we're going to look at these various costs and become and understand how they flow. With manufacturing costs that are related specifically to the product, we keep those linked to inventory since they are used in making that product. All product costs, such as direct materials, direct labor, and manufacturing overhead, are attached to a unit of product as it's purchased or manufactured, and they stay with that product until that inventory is sold. So product costs are an asset. They're part of inventory, and they continue on the books as an asset until that particular product is sold. Once it is sold, it goes on the income statement as a cost of goods sold. Raw materials, work in process, and finished goods are all product costs. Raw materials are all those materials that go into the product. Work in process is the section of inventory we utilize while products are getting completed. Once the product is done, it is in its final form, then we transfer them over from the cost called work in process into a subsection of inventory called finished goods. Finished goods are completed units of product that have not yet been sold to customers. They're waiting to be sold. They're good enough to where they are finished and they are ready to walk out the door. When direct materials are used in production, they start as a raw material when we purchase them or when they're delivered. But when we then enter them into production, they are transferred from the inventory category raw materials into the category work in process. Direct labor and manufacturing overhead costs are added to work in process to convert what we call direct materials right into finished goods. Once the products are done, they are in their final form, then their costs get transferred from work in process into another inventory account we call finished goods. When a manufacturer sells its finished goods to customers, it's at that point, it is no longer an inventory item. It will be transferred out of the inventory account finished goods into cost of goods sold. Okay. Now, in order to prepare financial statements, we have to know and understand where these various costs, what their categories are. Anything that is involved in product costs are an asset and are included on the balance sheet. Once that product is sold, it is at that point transferred from the balance sheet over into the income statement under cost of goods sold. Period costs such as selling and administrative costs, remember those non-manufacturing costs we talked about? Those are part of period costs. They are never an inventory item. They are expense on the income statement in the period in which they are incurred. So guys, which of the following costs would be considered a period rather than a product cost in a manufacturing company? Manufacturing equipment depreciation, property taxes on the corporate headquarters, direct material costs, electrical costs to light the production facility, and sales commissions. I want y'all to take a minute. What do you think?
Sales commissions.
Sales commissions? Anything else? You're right. Selling is a non-manufacturing cost. It's a period cost. How about property taxes on corporate headquarters? Wouldn't that be a non-manufacturing cost? It didn't say property taxes on the manufacturing facility. It said it's on corporate headquarters, which is non-manufacturing. So both of these items would go directly into the income statement, and they would be a period cost. They would not be a product cost because they are non-manufacturing costs. So guys, suppose you've been given a summer job as an intern at Isaac Aircams, a company that manufactures sophisticated spy cameras for remote controlled military reconnaissance aircraft. The company, which is privately owned, has approached a bank for a loan to help finance its growth. The bank requires financial statements before approving the loan. Our job is going to classify each cost listed on the next slides as either a product or period cost. And the reason we need to do this, product costs are part of inventory, which is an asset, and are not transferred into the income statement until the product is sold. Period costs flow immediately on to the income statement in the period in which they are incurred. So here are our various items. I'm going to give you a minute and I want you to look at it, and then we're going to go over them, okay? Jim, you think making me a bagel? Bagel with egg or bagel with butter and cream cheese? Either one. Too much? Thanks, honey.
Okay, so let's start. Depreciation on salesperson's cars. Remember, it's going to be a period cost because anything to do with selling is a non-manufacturing cost, and it would go on the income statement in the period in which it was incurred. Rent on equipment used in the factory. The key here is used in the factory. What are factories for? Making products, right? So you know it's going to be a product cost there. Lubricants used for machine maintenance, product. Salaries of personnel who work in the finished goods warehouse. It's a product. Excuse me, I was wrong. It's a period cost. The goods are completed. There's nothing else that needs to be manufactured in order to complete this product. This product is ready to be sold. It's just being stored. Hence, it's a period cost. If it was in the factory, different. Next. Soap and paper towels used by factory workers, it's going to be a product cost because it's dealing with the factory. Factory supervisors, guess what? Product. Heat, water, and power consumed in the factory makes it a product cost. Materials used for boxing products for shipment overseas that aren't normally boxed. It's a period cost. It's part of selling. Okay. Advertising, we know, are period costs. Workers' compensation insurance for factory employees, you know, would be a product cost. Depreciation on chairs and tables for the factory lunchroom would be a product. The wages of the receptionist in the administrative office, since it didn't say in the factory office, that's why it's a period cost. Okay. Cost of leasing the corporate jet used by the company's executives, period costs. The cost of renting rooms at a Florida resort for the annual sales conference, again, is a period cost. The cost of packaging the company's product is a product cost, because the difference between what we saw previously versus this is a consistent cost of manufacturing the product. In the other example, it was an unusual packaging because they were not normally packaged. Now we're going to look
at some new items called variable cost, fixed cost, and then mixed cost. Variable cost will vary. Fixed costs remain the same given a certain level of production. And then we'll talk about mixed costs. Cost behavior refers to how a cost will react in regards to changes in the level of activity. A variable cost per unit will be constant, but a cost that varies in total in direct proportion to the changes in the level of activity is known as a variable cost. So in other words, as levels of activity increase or levels of production increase, the variable cost is going to increase along with it. With costs, we have what we call a cost driver. Cost drivers are what we call drive the costs. It could be units produced. It could be machine hours, labor hours, or miles driven. This driver, all four of these are drivers, are what causes the incurrence of a variable cost. There's also fixed costs. This cost is going to remain constant regardless of changes in the level of activity. The average fixed cost per unit varies inversely with changes in activity. So if a cost is fixed, then the more units that are produced, that amount of fixed cost per unit is going to go down. Fixed cost can be both committed or discretionary. Committed costs really are planned ahead and aren't going to be changed in any short term. Discretionary costs can be changed in the short term period by making different decisions. So, straight line closely approximates a curvilinear variable cost line within the relevant range. So basically what they're saying here, you have a total cost and you have activity. So there is fixed cost and there are variable costs. And there is something that's called a curvilinear cost function related to the relevant range given these costs. The relevant range of activity pertains to fixed cost as well as variable, but if, honey, thank you, if office space is available at a rental rate of $30,000 per year in increments of 1,000 square feet, it's a fixed cost, but it's going to increase based on an additional 1,000 square feet. So you see here, if all we need is 1,000 square feet, we've got a fixed cost there. But if now we need to jump up to 2,000 square feet of space, well, it's a fixed cost, but it's only relevant to the amount of square feet we're going to rent. So variable cost per unit remains constant. Variable cost in total increase and decrease in proportion to changes of activity level. Fixed costs in total remain constant within a relevant range, as we talked about, but per unit, they're going to decrease as our activity increases, or they're going to increase per unit as our activity decreases. Which of the following costs would be variable with respect to the number of ice cream cones sold at Baskin-Robbins? What do you guys think? Which would be variable? I'll let y'all decide. Anybody?
Would it be C and D?
It would be C and D. Of course, ice cream and napkins. The more you sell, the more ice cream you buy. The more you sell, the more napkins you're going to be purchasing. Listed on the next slide are costs of providing an airline service. Classify each cost as either variable or fixed, and either direct or indirect. Consider the cost object to be a flight. Flight attendants and pilots are paid based on hours of flight time. So when we look at advertising, advertising is a fixed and indirect cost. Advertising isn't based on a particular flight. Beverages served on a plane are going to be variable based on the number of passengers, and direct. Regional VP salary is going to be fixed and indirect. Depreciation on ground equipment is going to be fixed and indirect. Fuel is variable and direct. Flight attendant wages is also variable and direct. Same with pilots' wages. But the aircraft maintenance manager salary is going to be fixed and indirect. Okay. Now we have something called mixed costs. These can have both a variable and mixed component. Excuse me, and fixed component. say utility costs. There's definitely a component that's fixed. But based on use, it also then becomes a piece of a variable component, because the more you're manufacturing, the more your utilities could increase. So you see, you have a normal charge, and then based on your kilowatt hours, it's going to increase. So you see, you can show this mixed cost to be where the total mixed cost is equal to the fixed cost component plus the variable cost per unit times the level of activity. If your fixed monthly utility charge is $40, your variable cost is 3 cents per kilowatt hour, and your monthly activity is 2,000 kilowatt hours, what's the amount of your utility bill? It's the 40 plus the 3 cents at 2,000 kilowatt hours of 60 is your $100. Now, we're going to talk about differential costs, sunk costs, and opportunity costs. This Northeast Radiology Department is considering replacing an old inefficient X-ray machine with the state-of-the-art digital machine. The new machine would provide higher quality X-rays in less time and at a lower cost per X-ray. It's going to require less power and would use a color laser printer to produce easily readable X-ray images. Instead of investing the funds in the new X-ray machine, the laboratory department is lobbying the hospital's management to buy a new DNA analyzer. For each item, indicate whether it should be considered a differential cost, a sunk cost, or an opportunity cost in the decision to replace the old X-ray machine with the new machine. So, the cost of the old X-ray machine has already happened, hasn't it? There is nothing you can do about it. It's happened, it's occurred, it's sunk. It's not an issue. The salary of the head of the radiology department, does it matter? No. Same with the lab department. The cost of the new color laser printer is a differential cost. The rent on the space occupied by radiology is none. But the cost of maintaining the old machine would also be a differential cost, one versus another. When we've got the new DNA analyzer, that's an opportunity cost. And then the X-ray electricity would be a differential cost. Okay. Now, no, whatever we decide, if we do the one machine or another, the cost of the salaries and the rent don't matter. They're not going to differ based on what decision we make. So they're irrelevant. They don't come into play if we purchase a new machine or we do the DNA machine. It doesn't matter. Okay. Now, relevant cost or irrelevant cost. Decisions involve making a choice between alternatives. The goal of making decisions is to identify those costs that matter or that don't matter related to the decision. To make decisions, it's essential to have an understanding on the concepts of what we call differential costs, opportunity costs, and sunk costs. A differential cost is the difference between any two alternatives. A difference in revenue between two alternatives we call that differential revenue. Both the differential revenue or differential costs are relevant to making a decision. And it doesn't matter if these are fixed or variable costs, they're still relevant. An opportunity cost is the benefit, the potential benefit that's given up when one alternative is selected over another. You have to consider these, even though you don't actually have factual knowledge of specifically what it is you're giving up, but you do need to take that into account. For you guys, what are you giving up by being in class? You could be working. Sunk costs have already happened. They make it doesn't matter. They're totally irrelevant in making decisions. It's already happened. In business decisions, a sunk cost is a cost that's already been incurred and can't be recovered. Sunk costs are sometimes contrasted with prospective costs that can be incurred or changed if an action is taken. So here we have this chick. She's trying to decide, do I take a train to Portland to attend a concert? She has the money to do either, but you don't want to waste it needlessly. Is the cost of the train ticket relevant to this decision? Meaning, should the cost of the train ticket affect the decision to whether you drive or take the train to Portland? Well, of course, it would matter. That would be part of the decision. Right? Suppose you're trying to decide whether to drive or take the train to Portland. You have ample cash. Is the annual cost of licensing your car relevant in this decision? It's going to happen anyway. It's not relevant. Suppose that your car could be sold now for $5,000. Is this a sunk cost? Remember, sunk costs have already happened. This hasn't happened yet, so it's not a sunk cost. Okay. Now, in preparing an income statement, there's a couple ways in preparing this for a manufacturing company that provide us with some better information. We're used to what we call the traditional format. We take our sales minus our cost of goods sold. It gives us our gross margin. We take our non-manufacturing cost to come up with our operating income. But what's beneficial for management is what we call a contribution income statement. We take our sales. We subtract from sales our variable expenses only to come up with what we call a contribution margin, meaning this is what we've got available for our fixed expenses. And then we get our net operating income. The bottom numbers are the same, but the information it's providing for management helps them to understand what they need in a contribution margin in order to pay their fixed expenses. The contribution income statement is going to be used for various chapters here that we're going to talk about. So, Marwick's Piano purchases pianos from a large manufacturer for an average cost of $2,450 per unit and then sells them for $31.25. Companies selling and administrative costs for a typical month are shown here. Okay. During August, Marwick sold and delivered 40 pianos. We are going to prepare a traditional income statement. Then we'll prepare a contribution format one. And we'll talk about why one may be confusing to another. All right. So if you look here, under traditional, we're going to show our non-manufacturing in the income statement under selling and admin, and then everything else we'll put into the inventory. So you see, we sold 40 pianos. We have our cost of goods. From there, we have our gross margin and our different expenses for $8,000. If we use a contribution, we split up the variable costs, which would be the cost of piano along with the sales commission, the delivery of pianos, and clerical. Those give us our variable costs. Then we take all of our fixed expenses. Now, our net operating income staying the same no matter what, but this allows us to derive at our contribution margin to see what's available to cover our fixed expenses. Okay. Fixed costs remain constant in total, but they would vary on a per unit basis inversely with changes in activity level. So as the level increases, the fixed cost per unit decreases. Showing fixed costs on a per unit basis on the income statement is misleading because management can think that they're going to operate the same way as variable costs, and they don't. That's why fixed costs need to be taken out and treated and shown as a whole. Okay. There's a lot we covered today. And this was a big generalization of some of these cost concepts we need to become familiar with before we delve into each of these chapters. Any questions at all? So if we go back to our D2L, know that you will be able to access what is due in this week 1 under links. Take time to go through this review. Then for the homework, you can launch it here and see much of what we covered. It should work for you with these various questions. So this is just showing those fixed costs and the variable costs and how to compute this. Again, just like we did, you're going to do a traditional income statement and a contribution. This one, you've got various costs per unit. And in this scenario, we have to talk about what are direct manufacturing costs and what are the indirect manufacturing costs. And then looking at the cost object with output being 20,000, what gets traced directly as a direct cost to the manufacturing department and as an indirect. And then the number 3, assume the cost object is various sales representatives. Furthermore, assume that the company spent 50,000 of its total selling expense on advertising, and the remainder of the total fixed selling expenses comprise the fixed portion of the company's sales representatives. When the company sells 20,000 units, what's the direct selling expense that can be readily traced to individual sales representatives? And what is the indirect selling expense that cannot be readily traced to individual sales representatives? I'm going to help you with this part. The others I think are fine, but I just want to give you this one. Okay. Then we've got based on volume, what are our variable costs and our fixed costs. And then this part, assume the company produces and sells 45,000 units at a $16 selling price per unit. Prepare a contribution formula, format income statement. Okay. Again, we're dealing with a traditional income statement and a contribution format income statement. Here's your traditional. Here's your contribution format income statement, where the variable expenses are separated and you end up with a contribution margin to determine what's available to cover your fixed expenses. Know that the quiz consists only of 10 multiple choice. You will be able to, you'll have 2 attempts at that 10 multiple choice. There will be different questions for you when you do that. And you have 90 minutes to complete each time. Oh, and then the Excel. The Excel is pretty simple this week. So it gives you oops, I'm sorry, I can't do that. Here, preview it. So basically, you're going to use the Excel sheet provided, and then they're going to ask you, as you see here, check your worksheet by changing the variable selling costs on the data area to 900. Keep all the other data the same. If your worksheet is operating properly, the net operating income should now be 700 and the contribution margin should now be 4,700. Okay, that's the first one. Then the second part. Now change all of the dollar amounts in the data area so it looks like this. If your formulas are correct, you should get correct answers to the following questions. So your gross margin should be 7,000. Your net operating income should be 1,600. And your contribution margin should be 5,600. Then if sales are 8% higher, enter that new data also. So I'm just providing you with this. So this first week, it flows pretty smooth for you. Okay. Any questions, guys? How's everyone doing?